I'm Richard, Richard Diamond. I will be one of your tutor for the market risk. Although I take this lecture with a great interest, I inherited a lot of material from Alonso. Alonso will be another tutor who you will see mostly in relation to the credit risk. And perhaps I want to forward that we have specific goals today. Make the value at risk clear, make the expected shortfall derivation explicit. But it's perhaps an overture to the elective that's recorded on the counterparty credit risk. So if you want to go in depth later on into the market risk, into the regulation, there will be an elective recorded. We made them available in the second half because of the, the sequence of material that goes with it. But nonetheless, well, let's dive into the risk and the definition, the Oxford dictionary, the French word, and associated with running into danger. So, but if we look at it more formal, and I want to highlight for you, the text is quite seminal in terms of the risk management practices. So if you want to work in the market risk, make sure you at least know how to cite that thing. Now, there is another kind of approach to risk, the more formal approach, and then another colleague, name is Aaron Brown. He had a book which called Red-Blooded Risk. Also, Wiley. Now, that one is more about his experience of being a risk manager in the AQR. AQR is a large buy-side player, asset manager. He mostly speaks about the things that are written in a textbook, like we imagine there are farmers and they go and they buy futures to hedge off their exposure. Well, this is ideal world, not quite working like that, and people buy products without knowing the risk profile, or most of the time they make decisions, they try to make money out of hedging as opposed to focusing on managing the exposure, on managing the limits. And back to the definition. So running into danger. More formally, so identification, assessment, and also prioritization of risk. Well, the point is the economic application, the economic capital. If you take any trading book, it will be exposed to probably good, 20, or even if you being a quant, you have a portfolio of 200 stocks. So how many risk factors? Well, you can be smart. You can be decomposing and say, okay, I have a market index that can explain variance, 60–70% of variance. So I probably have one factor covering that. Okay, but then you start to unfold. Some stocks are prone to defaults, other businesses prone to oil prices, other businesses prone to the interest rates, and so on. So from that picture, the prioritization is very important because, and we have, again, more formally, techniques such as the decomposition of large covariance matrices into principal components, for example. So what does it allow us? And all of that idea about the determinant analysis and the PCA is that we end up with 3 instead of 200 risk. The factors, the time series that would be underlying the whole matrix or the whole portfolio. So that's that bit. controlling the probability and impact of the unfortunate events. So this is exactly where the formal measures, such as the VAR and expected shortfall, are coming from. And being a simple formula, the value at risk is very accessible to compute analytically or parametrically. But it's not the only approach. And in fact, today we will see the three main approaches. And if you work in market risk, you know that the regulators insist on at least two alternative quantitative estimation of the same risk factors. So two ways of computing VAR, for example, value at risk. So again, controlling the unfortunate events. So we want to know the extent of our losses. We want to know our worst loss. And those are the things for the value at risk and the expected shortfall. But also, very important, a good risk manager should be able to point out to the traders that they are not having enough risk. So because back to the classical portfolio allocation and the efficient frontier, if we remember the variables for the efficient frontier. So this is sigma pi, the whole portfolio risk. And this is the mu pi, the portfolio return. Now, the efficient frontier, or the part that we are interested in, that part is really the result of so what we have here is Markowitz bullet. So within the MPT paradigm, within this optimization where the variance of the portfolio, so weights of the portfolio times covariance times weights, and because we pre-multiplied, it will be transposed. So we minimizing that quantity within that paradigm of minimization of variance. Or if we take, again, let's connect things. Thank you, Victoria. So that would be the portfolio risk if we take a square root over the variance. Now, within that paradigm, the optimal, if you start simulating weights, so randomly, just randomly, the weights that give you the frontier, there is no more kind of behind the frontier. You always end up with this bullet shape. Now, what do we have here as a simple principle? That if you want to have higher return, you will have to have sufficient risk. So there is no, the frontier is not going. Let's say it's not in a mirrored world. It's functioning this way. So you cannot have less risk and higher return. Okay, so it's as simple as that. And a good risk manager would be always pointing out that there is not enough exposure to risk. If, for example, the P&L running at a very low volatility, or, well, that depends really on the nature of business that you are doing. But again, if you don't have volatility in your portfolio, things are not going to take a direction up or down. Now, with derivatives are different. Derivatives are more or less pure bets on volatility. So you would be delta hedged. but that's the topic for the next module. So to maximize realization of the opportunities, it's also a duty of the risk manager. Well, perhaps the strongest examples that we have, out of which we don't have control, the earthquakes, and even the most powerful earthquakes, they can start with a small trembles, but what have been implemented in that regard is that you can have an early warning system. So if you have a particular pattern of tremble, if you have a particular types of waves in the ocean, you would have, it travels very fast across the Earth, literally. You might, from the time the signal is picked up and communication is sent across the Atlantic, things can travel in under minutes, the Earth, if it's something tectonic, really. But still, under minutes means you might have 90 seconds or a couple of minutes. And that's actually enough to go down from the 5th floor. So it makes the early warning system makes a big difference. And also, like the foresight, I don't know how many of you watching the Billions. And they had that, the TV series. I think it's, well, it's a favorite. And so there's a guy, he's running a hedge fund. He's mostly doing maybe not so lawful things, but it's all very, has a very prestigious front. But the level of his insight, for example, he can, in one, there was a short scene, he quickly looked into the news and noticed that the earthquakes in Mozambique, and then he shorted the Brazilian miners. It's a movie. It's not the. Yeah. So why? Because the wave comes and essentially the water flow rises in the Amazonia, and the dams get damaged in the places where the Brazilian miners do the excavation. So these kind of things to make the connection to the level of foresight. And I think, well, the ideal, the perfect risk manager would do just that. He would notice one thing and then make a necessary connection. I think if you want to develop your intuition, that's the. It's a short book. It's actually on the CFA website, and Practical Guide to Risk Management, the Coleman book. It's worth reading, and he would be again talking. Well, first of all, as the risk managers and working in quant finance, our primary task is uncovering unknown risk. So things that we can compute, things that we can explicate. Like I said, I have a huge portfolio. You go and look for the factor that's driving that portfolio, such as the market risk. By the way, when I say factor, for example, well, people would mean different things, but just to get our, well, since we're talking about factor, well, if we start to do as formally a regression, and if we regress the returns on the asset, we'll have time series of returns. So that would be the T means we have a column time series of returns. So we have a column of data. T plus 1, R at T plus 2, and so on. Okay, if we regress them on to what? So returns on an asset, regressing on the returns on a market. Typically, that would be the time series of S&P 500 returns. there will be a residual in that regression. And well, the factor here, and yeah, the factor here is time series of S&P 500 returns. So, and if you think about think about it in two ways. First of all, when you hear the word factor, it's usually associated with the source of randomness. So if you have an SDE, a stochastic differential equation with drift and diffusion, so if people say to you, again, the factor, what do they refer to, the drift or the diffusion? No, source of randomness. The drift is known. The same thing as here, the beta. And in fact, if you regress returns on returns, the beta is your kind of constant. Well, no, the beta would not be a drift. If it would be a constant here in this regression, that constant will be the drift. So if we have an intercept, that would be the drift in quant finance terms. The beta has a role of what? Correlation. It's a linear model. If you just have two variables, if you regress one normal variable on another, you would have the underlying model with linear regression. You will have cloud of returns, and the correlation will be governing how that line is the tangent of the angle. But back to it. Yeah, so the factor is source of randomness, and if we know the drift, it's a known thing. We can subtract it, and we can ignore it. The same with derivative. If we hedge up and down, we ignore the drift. So always means source of randomness. So the factor is your diffusion. If you have a multi-factor equation, it means it has several diffusion terms. Well, we haven't met those, but it's coming on you mostly in interest rates. So dx1, dx2, dx3. So that's thing. Of course, the time series of S&P 500 returns, it's more or less IID process, more or less individually normally distributed. But we also have here, by means of doing this regression, we kind of decompose into the systematic, right? Because, well, we introduced, there is no inherent systematic factor. It's like a point of vantage. So it's like the Archimedean thing, give me a point, and I will leverage the planet around it. So if I choose to take another something else, not the market risk, market index returns, but interest rates, that would be my main factor. So my systematic factor is actually completely arbitrary. It's just everyone agrees that the market index returns are typically the main factor, the systematic factor, and rest is rubbish. Rest is idiosyncratic. But I can turn it around and actually put something else in the middle of the model and say the rest is idiosyncratic. Right, the known risk. Usually we are talking about the P&L, and if it's a portfolio, then we decompose P&L into the individual stocks of the portfolio and covariance. If it's a derivative, we decompose P&L with Greeks and all of that. If it's interest rate product, we decompose P&L into a series of cash flow payments, all different approaches, but the same principle. Okay, now the visualization or presentation of risks as well, because it has been so many cases that the information is there, the firm-wide risk, and even prior to the credit crunch, there are plenty of analytical notes and reports floating around. But even if we go back to a simple example of a derivative, the need to introduce var as a single number came across that before the var era, before it was invented in a JP Morgan, so to speak, they just produced for each instrument, they just produced a separate profile like it was pages of Greeks, but no summation, so to speak. So each derivative had its own separate profile, and it's just being printed out separately. Now the problem, of course, why they've done that is that they wanted to avoid issues of doing and dealing with the correlations in a large portfolio, because the more you try to aggregate things, the more correlation between different assets, different derivatives, different instruments, different rates at different maturities, and so on, the more correlation becomes an issue. And in terms of the perhaps early warning signals, people look at the spreads, and of course, there are two kinds of spreads. For the financial system, typically, people look at the LOIs. So that's a spread over the, let's say, 3 months LIBOR minus OIS, compounded overnight to be over the 3 months. And what happened it normally behaved like this, a very insignificant but very, very small, close to zero. And what happened in the financial crisis that it jumped. So suddenly the counterparties stopped trusting each other even for the 3 months time for a foreseeable future, and the 3 months funding suddenly became noticeably much more expensive than the OAS. Now the OAS is still the overnight index swap. It's not just one night. It will be one night over the 3 months into the future averaged. So it will be corresponding. It's not that just the 1 night rate and 3 months rate is different. It's a history of, because technically, if you average the rate, you should get yourself a term rate for the term. But things don't match like that anymore in the market. And that's why the LOI spread got so much prominence. Because again, if you look at the historical evolution of the risk-free rate, and if you geometrically average it over the period, you don't get yourself 3 months LIBOR, you don't get yourself 6 months LIBOR. So clearly I'm probably talking early about it, but what's the difference between, let's say a loan for 1 month and 3 months LIBOR? Well, the commitment, you committed to 3 months. The 1 month LIBOR has optionality, you can stop. So the 3 months normally would be more expensive because of the credit optionality. But we are talking about the early warning system, and we're talking about spreads. So 2 examples of spreads in the financial industry. So this is called the LOIs. What other kind of spread if you, it would be unfair. The other kind of spreads that we are looking at, or people start to very closely trace as the credit crunch, as the sovereign credit spreads. So the credit spread is the special kind of instrument that's called credit default swap. And again, we have to leave loan before we get ready to work with credit. But as the spreads go, it's just a spread in basis points. So the scale here is in basis points. Well, and if you have something like the Greece, you would have this story. And if you have something like the Germany, of course, it would be very small compared to now. So the credit spreads measured in basis points, and it's a price you paying actually to get the protection from the default. But it has actually more to do. It's not an insurance product. It's so if credit spread is, for example, let's say 50 basis points on Deutsche, it's probably now 180 or something. But it means that you'll be paying 50 basis points per annum to get yourselves paid if in case the Deutsche, for example, will not pay on the debt in case of default. Now things are more complex with that, but the early warning system and now we have a lot of time series analysis. What typically, very simply, people look at daily and weekly changes. So weekly changes and correlation among things. Now, there are much more, of course, richer instruments of the time series analysis. And if you want another analogy, the normal time series and financial time series, they're actually integrated processes, which means that, difficult to put it simple, but such a device as a Hurst exponent has something to do with it. Essentially, it regulates how much memory the process has. So if process doesn't change just about the same level, we say it has memory over time. If it's the Brownian motion are not supposed to have memory. So, but the problem is that real financial time series do. So especially the interest rates. Now, if interest rates start behave like to be without memory, then I would get worried. Okay, right, and that's what we've done to make risk easy to see. That's why we, at the end of the day, have a VAR number, a valued risk number. And then, if you again, if you're not familiar with how risk management is done, after you quantify things and run VAR computation by different methods and go in depth of detail of methodology related to each particular instrument, after that you have to then submit a separate page, which or a separate white paper, which called risks not in VAR. So risks not reflected in your quantitative methodology. So, and that's the unknown or anticipated risks. Now, with the life of the quant is easy because we can actually, we have a good models and good methods to quantify the risk that people want to see, want to hear from us. The equity price risk, the interest rate risk, if it's a product of interest rate, depending on interest rate payments, FX, commodity price risk. So each of these area has their own models, how you simulate the asset, such as equity or the interest rate. And then each of these areas has the models how to price derivatives specific to equities and specific derivatives specific to the interest rates. With interest rates, though, there are instruments such as interest rate swaps. it's not a derivative per se. You just exchange cash flow, fixed versus floating. You're not making a bet. Not the option bet actually on the interest rates. So, but it's still called a pricing, although it's not a derivative. So it's kind of one exception. So sometimes again, or the CDS, there is no model to price the CDS, but we still we can take this thing in which is in basis points, the top one. And it's indeed, Michael, the top one, the credit default swap. And we can convert at each point into the probability. So, and that would be referred to as the pricing. So, but just simple conversion between spread and probability. There's no real pricing in dollar terms here. But the probability of default is a useful quantity to know for such computations like CVA and for other risk management applications. Because if you know the probability of default, then you just take your value at risk, not in terms of the VAR, but your exposure essentially, and multiply by the probability of default plus what's the rest, and multiply by the probability of not default, and you get yourself the expected value of your position. So the probability to get probability of default from the credit risk is regarded to as pricing. So it's and we typically get it from the CDS if it's sovereign or corporate. Now that's the easier risk, or the risk of a particular instrument or structured note or anything that it can be again rated differently than the risk of the party that issued it. That's one bit, and the counterparty risk goes into it. So why do we need to compute things like a CVA? Because we take our exposure to other counterparty, take its probability of default, and then we have the amount of, the expected value that we would lose if they would not pay us. So that's that. But somehow, so I would group all the three perhaps into the transaction risk. And somehow the concentration goes also on the credit, and it also goes into the, well, to answer if we are concentrated or not, you have to see what? You have to see the correlation between the assets. And then you can see, if all of the assets are going to co-move. And particularly if correlations, for example, start to dangerously increase, then suddenly you get concentration where there was none. So the portfolio concentration is really to study the correlation of things. So again, we're talking about the same principle, the spreads on one hand and correlations to look as the early warning signals. So okay, well, and just to wrap it up with an interesting note, we usually think of correlation as something that we compute and we know from historically. But then there are traded correlations in the market. A lot of instruments imply certain correlation, like correlation between rates at different tenors, and but also so the future implied correlations are also possible to look at. But back to the market risk business, because this is again where it's estimable, where it's made explicit with the VAR and expected shortfall. Okay, getting closer to the point, and the sensitivity with regard to the adverse changes in rates, FX, commodity prices, equity prices. Now, this is all quite implementable, and that's actually coming from the Fed. Their pages on the formal guidance on the market risk. But each area has the favorable techniques with market managers. For example, if you work with interest rate products, with interest rate swaps, the terminology is, for example, bumping the curve. So you want to change 3 months rate up or 6 months rate up by 50 basis points, and then see how the product will behave as a result. So you, with interest rates thing, you would be bumping the curve. So you change at one tenor, at 6 months or 1 year tenor, and see how things will reprice, bumping the curve. If you work with FX rate, and particularly with FX options, the same idea, well, but it would be called the volatility bucketing. So you change the implied volatility and see how the option, or maybe more complex structured option, will change as a result of changes in underlying vanilla volatility. So the volatility bucketing. Now, commodity pricing usually cyclical, so typically we, even if you have like something like a sinusoidal model, and just to see what would happen if commodity price starts to oscillate. The question is, you just setting up the period, but there is that. And equity prices, we will talk about it a bit more because in the VAR example, but you have choices. You can take, for example, stress periods. 2 years of stress periods, and see how your portfolio would behave if you draw your returns, your market returns from the 2007, 2009. So the equity prices. Period. So if you run the prices of your assets, or where you change the factor from a stress period, that's that's one of the implementation of the historical simulation. So, but that would be, a stressed VAR, SVAR, in fact. So it's part of the historical simulation. There is that, and commodity prices are what they are cyclical. Again, it's a question of the ability of management to identify, measure, but also to present things to the decision makers. But I think the language itself is telling how the regulators are concerned that with the complexity that you could have something in one side of the institution, because normally only the firm-wide risk people aggregate things, but they exist completely outside of the front office operation. So, and typically, if you look how the risk management propagates a bank or a fund, you have a trading desk that specifies on a particular product. Now, there might be or might not be a risk manager assigned to the trading desk, and but then it would only work specifically on that asset. It would bump the curve and tell you what will happen to the swap. It will not tell you what would happen if the other party would default, for example, because for that they would have the credit analysts so typically things do not get aggregated into each business and a sub-business, and nobody see it. But then when information comes from different parts of the organization into the what's called firm-wide risk, those guys actually, well, politically they have no power, they have no leverage in terms of and it's not that, but it's mostly difficult for them to kind of convey back because their role is not to support their role is primarily to organize and report. And even if they, and how you aggregate things, how you aggregate positions in a trading book of derivatives, and then how you aggregate one derivatives book with another derivatives book, and then you might have other type of business, you're writing mortgages and resecuritating them and other them. So how we would aggregate all of that into the coherent risk picture, and then try to see what it's really sensitive with. That's really an art.